Hello and welcome to Trade Maestro. Thank you for joining us. We know your time is valuable and we take that very seriously. Our presentation will begin shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable. It's comprehensive. And it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning. Good morning. Welcome to all of you. Good midday to those of you in the middle part of the United States, and good afternoon for those of you over on the East Coast. I hope you're doing fantastic today. I'm Jeremy Whaley from Trade Maestro, and it's great to have you join me on the live stream as we are rounding out our Pick Winning Stocks Challenge that we've been doing now for 3 weeks. And this will complete, very, very close to completing it as we're getting into day number 19. Now, you might be thinking, well, day 20 and day 21, that's going to be over the weekend. Are we doing it tomorrow? The answer is no. Basically, the weekend sessions are some bonus content, and I'm going to be deciding tonight exactly how we're going to do that. I'm either going to send it out as emails, as bonus content, or I will put it into something for next week that we'll compile together. So that's how that's going to work. But today is technically the end of the 3 Monday through Friday weeks. And next week, we're going to be doing some more exciting stuff. And then we'll be making the transition, as I talked about this past Monday, over to the new format, which is going to be Wall Street Secrets Live. It'll be more of a show format. And we're looking forward to doing that and getting into all that. It's going to be great. So here's the deal. The market's closed today. It is Good Friday. So happy Good Friday to everybody. If you come over and you take a look at the charts, you're going to say, well, they don't seem like they're moving very much. And that's because they're not. Because it is, in fact, a day that the market is closed. But I do want to touch quickly on what ended yesterday. We were somewhat bearish in our session yesterday morning, down about 250, 300 points. Ended the day down 500, which sounds like a lot, but when you look at the scheme of things and the big picture, it's really not. As we talked about yesterday, the big move yesterday was not even the intraday move, but rather it was the fact that we gapped down early in the morning. Most of the day yesterday, that candlestick was actually green as it was trying to trade up and fill that gap. And there was a lot of buying pressure. And that's what you're seeing right now in the market. You're still seeing a lot of buying pressure. You're seeing your stochastics heading to the upside. You're seeing all these support levels coming in to support it. And when you look at the other indices, they're not telling a very bearish story necessarily either. Here's the S&P 500. As we talked about yesterday, it's just pounding into this support level right here. It's really establishing it. We've got a lot of momentum trying to push it up. There's just nothing that's been able to push it up yet. And so it feels like, it kind of looks like, and it very much feels like we're trying to put the bottom in here. And this very well may be the bottom of the swings that we're looking at right now. This is the NASDAQ composite that you're looking at right here. And you're noticing, again, just multiple days reaffirming and hitting that support level, which is a bullish early indication. It's not a sign to buy. It's just a sign that, hey, it's not quite time to short more. It's not time to sell right now. We may be in the middle of a transition, or maybe it's just taking a break. And that's what we've got to decide as we're moving forward. If you're in my Sunday night profit picks class, which you're all welcome to join, those of you who are already members, you'll be there. Those of you who are not members, you might want to join us. Head over to Trade Maestro and get enrolled as a member over there. But we will talk about where are we going from here. Are we going to actually be able to rally and head back up to some of these other pivot areas? Or are we going to get stuck for a little bit? Or are we going to, see the bottom fall out and continue falling? My intuition right now, and we don't trade on intuition, we trade on the facts of what's happening, but my intuition is that we're going to probably be stuck for another 2 or 3 weeks, as I think that we're putting the bottom in. At least that's my current opinion on it. We can obviously, that can change rapidly. It can change fluidly. It just depends on what day-to-day market conditions present. But that's where we are right now. And that's what I think is shaping up. As we get into the last couple weeks here, last week really, of April, week and a half or so, and start shaping up for May. So it's going quickly, and here we are. It's hard to believe we're already to the Easter weekend. It's hard to believe that we made it to Good Friday, and there's no trading today because it is Good Friday. Let's take a look really quickly over here at crypto. Not a huge change in the crypto world. Bitcoin very much stuck between these two moving averages, as you can see here, just really kind of going nowhere, which is, again, kind of what we thought was going to happen, especially moving into this weekend. We might see Sunday. It seems like late Saturday and into Sunday, a lot of time movement comes in for Bitcoin and crypto. But I think for today, we're probably looking at a whole lot of nothing. Not a whole lot of excitement right here. So that's really where we are. I do want to touch on the Solana picture. This is one that I've been very excited about sharing with you. It is continuing to be stuck today, meaning that it's right on our 50-period moving average and has not broken out to the upside yet. But if you look at all these candles that we've been working with all week, you can see that pressure building to the upside. I've been talking about how exciting this chart is because we've really put together the majority of what we need for it to complete a head and shoulders or an inverted head and shoulders formation. That would be your left shoulder over here. This is your head down here. Here's your bounce. We're looking for a little confirmation on that neckline, and that's kind of the break I would be looking for is can we get a little bullish candle to tap that neckline, come back down, test this support level, and then ultimately break out. That would be your right shoulder. That would complete an inverted head and shoulders. If we see that whole formation, which we're very, very close to seeing now, if we see that, it is a terminal pattern for the preceding bearish trend. This is a trade that has had a lot of great volatility. It's down about 50% from where it was just at the beginning of the year, and really, really positioning itself to make some great moves in the last half of the year. So that's Solana. Very excited about that. I think that's probably all we need to address. We talked about gold and these others yesterday. No big changes there. So I think that will complete our big market wrap up. If you got any questions on that, feel free to type it into the chat. A little bit lower attendance today than maybe we've had in the past, but it's to be expected. It is Good Friday, and people aren't sitting at their computers trading and doing stuff that they usually do during the day, but rather they're out doing whatever they want to do on Good Friday because it's a day off. It's a federal holiday. All right, folks, let's jump in. If I can get my slideshow over here. Clearly, I'm not pushing the right buttons. Let's try that. There we go. What I want to do as we wrap up this week of risk management as it relates to the Pick Winning Stocks Challenge, I want to talk about the subject of stops. Why stops? Well, because you need to use stops. If you've not been using stop orders, or at the very least using an alert to tell you to get out of the trade when things go bad, then you're really just selling yourself short. And it's one of the biggest reasons that people get into big trouble with their trades is they're just not doing what they need to preserve their capital on any level. You can sustain a lot of losing trades, as we've looked at this week. You can sustain a lot of losing trades if you manage your capital, if you manage it to at least some degree. That's not to say you're not going to have drawdowns, because you will. You will have trades that lose money, and over time you may lose or draw down a huge percentage of your account, but there's no reason to go broke. There's no reason to completely destroy all of it. And the way that you avoid that is by doing the risk management stuff that we've been talking about this week. So I want to talk about how we exit trades, and I want to talk about the stop order itself. Now, there's a few ways you can do it. One way is manually. And this is what a lot of people like to do. They like to say, I'm just going to manually execute my stop. I'm going to manually get out of the trade. And that's fine if you have the discipline to do it. If you have the discipline. The real challenge and the reality is most people just don't have the discipline. And so what happens is whenever their alert is triggered that says, hey, go check out your trade, it's going down, you want to get out, instead of going and checking it out and saying, oh, I better protect myself, they say, that's painful, I don't want that loss. And then they make that decision in the split moment to stay in the trade. So that's why stops are useful, because what stops do is they bring in a function of automation. And as much as anything, the automation is there to keep you honest and prevent the emotional roller coaster that happens in the live trade itself. Now, if you've been trading a long time, and again, if you have the discipline to get out, I don't have any problem with doing a manual exit. I have no problem with that at all. But again, what I'm saying is most people don't have the discipline to do it. So let's look at automation a little bit. Here's the reality of automation. Modern trading platforms have allowed us to automate almost anything we can think of. That's the cool thing about modern trading platforms. In fact, you could, if you know how to do it with your platform, you could automate the entire execution. You can automate the entry. You can automate when we get to a target, take my profit, and you can automate whenever we get to a certain price point, stop out and take the risk off the table. You can either do other forms of automation where one type of a trade ticket triggers other trade tickets, and you can create all sorts of complex trade automations. Not all platforms allow very complex automation, but most platforms allow at least some automation. And I don't think I've seen a platform in the last 25 years that doesn't at least automate and give you the option for setting a stop order, because a stop order is the oldest form of automation. Everyone should at least understand the stop order, because what a stop order does is it is designed to protect you from yourself. Now, if you want the really advanced automation platforms, your platform may or may not provide it. You might need to go into like the desktop version of TradeStation or the desktop version of Thinkorswim, or even some other platforms that will allow you to write really advanced scripts. I'm not saying that you should do that. It does add a different level of complexity. But if you want automation, it's there. But the thing that's simple, the thing that everybody can do, is setting a stop order. So what is a stop? A stop is simply an order that you place with your broker that says, if this trade falls to this price, close my position. That's all it is. It's just simply an order that you give to your broker, and it says, if the trade falls to this price. So it could be, if you're trading Apple, if Apple falls down to $100 or whatever your stop price is, if it falls to this price, then close my position. Now, you might listen to my words and hear that there's a condition in there. If, then. That's what a stop order is. In its core, a stop order is a conditional order. It says if criteria is met, then execute trade ticket. That's all a stop order is. And what I want you to understand about stop orders, first of all, they have been around for decades. They've been around for decades. It's used as a tool to preserve your capital. But what I want you to understand about it is an order that you place that basically triggers another order. Once you understand that piece at the stop, it becomes a little bit easier. I didn't understand this. Nobody taught this to me early on. It took me a while to actually conceive how a stop worked. What a stop order does is when the price hits your price point, when the stock or the quote price, when it hits the stop price point that you put in there, it literally says, okay, this order is just sitting here waiting. And when this criteria is met, now I'm going to send the order over to the dealer. Okay. So people have said, oh, the brokers are out there running stops, market makers are running stops. That's actually not how it is. There's not a list of stop orders on the books for the market makers. They don't see that. The stop order is actually just a conditional order that sits on the computer for your broker, and it says when this criteria is met, then send my order. And when it sends the order, it can be one of two types of order. It could be a market order or it could be a limit order. Now, the name that we give that is a stop market or a stop limit. A market order, of course, is going to go straight through. A limit order is going to be met at that price or at a better price that's more favorable for the trader. That's the criteria for a limit order. Now, the limit order doesn't ever have to be filled. Market order, it goes straight through. So it's supposed to be filled as quickly as possible. You just don't know what the price is going to be. And that's the challenge of the market order. But the stop itself is going to trigger one of those two orders, either the market order or the limit order. That's it. So the stop is kind of part A of the order, and it just says when this price is hit, then trigger the rest of the order. And that order is either a market order to immediately sell your position, or it's a limit order to sell your position at this price or better. Now, I'm using the phrase sell. You can actually flip it. If you're in a bearish trade, then the stop order would be the opposite. It would be an order to buy, but to buy to cover. your position, okay? So let's get over to an example here. And this is a trade set up on DocuSign. And what you can see is we've set this up with an entry of 223, and we've got a target of 243, so that's $20 a share. And if we trade down and we hit our stop, we've got a stop at 210. Now, this is the way that I teach people to trade and set up their orders. You've been seeing me do this all week. We're going to have an entry, a target, and your stop or your exit price. Watch the trade and sell. These are your two choices. You can watch the trade and sell when it gets down to your exit price. That's option number one. That's the manual execution. Or you can place your order and let the computer do the work for you. And if you do the latter, then what happens is you're not sitting here on pins and needles saying, I got to keep up with it. You're not sitting here saying, I got to track every detail. I've got to be glued to the computer screen. You can be off golfing. You can be taking Good Friday off. You can be, shopping or doing whatever you want to do. And you know that the order is already going to do its thing because you've set it up with automation. That's peace of mind. It's honestly, it's lifestyle freedom, right? So how does it work? Let's come over here and take a look at an order form. This is from TradeStation. You simply put your ticker symbol in. You're going to tie this to the order that you've already got in your account. You tie it to the order that's there. You've got your quantity. So in this case, I did 500. And then you see your order type. Notice that it says stop market. And right next to it is your stop price. What that says is if DocuSign trades down to 210, then sell 500 shares of DocuSign at a market order. And I want to be clear, we're not selling at 210. What we're doing is we're saying if it hits 210, then put the market order in. So you could get filled at 210. You could get filled at 210.05. You could get filled at 209.98. You could get filled at 209.30. It just depends on what the actual quotes are and where the movement of the market is going. What the market order does is it says go in and get filled as quickly as possible. What the stop order does is it says trigger that market order at this price of 210. That's the difference in those two orders, okay? This came up Wednesday night in our group coaching, so I'm spending a little bit extra time on the market versus the limit order here. That's what you need to understand about your stop orders. It's really simple. I mean, this is all it is. It's just simply saying when the price hits this, trigger my order and liquidate my position, okay? Now, what about your stop placement? Let's talk about that just a little bit here. Generally speaking, we want to set our stop order just below our support. If you're in a bullish trade, if you're in a bearish trade, it's going to be above your resistance. But generally speaking, that's where we want to set it. So if you come back to this trade that I set up on DocuSign, you'll notice that I've got a green support level in here. You'll notice maybe that there's a small candlestick shadow underneath here, and that's the bottom. And notice that I put my stop just under that a little bit. The reason for that is because your support level is where you're expecting buyers to show up. That's where you want to give it a little bit of room to be flexible. People say, well, why do I keep stopping out all the time? And then the trade goes the direction I want it to go. I say it's because you set your stop too tight. If you set your stop too tight, what happens is your trade will come down in the natural ebb and flow of the intraday volatility. It'll come down, it'll stop you out, and then it will continue going because you were right. That's why. You were right. You did your right analysis. It really was bullish. The challenge was not you did the wrong analysis. The challenge was that you didn't know how to set your stop right. So I want to talk about this a little bit. We want to put that stop below your support and resistance because what it does is it gives the trade room to be a little bit flexible. You got to learn how to be flexible. The worst thing you can do is snug a really tight stop up there and you're saying, I'm going to try to preserve everything I got. You can't do that. I mean, you can, but you're going to stop out a lot and you're going to have a lot of losses. And you have a lot of losses that you didn't need because the trade was actually a good trade. So this is one of the biggest things that I work with my private clients is loosening up their obsession with keeping stops super tight. I'll give you an example. Work with some day trading clients who, they'll look at a daily chart get a big picture view of the daily chart. Then they'll go in and they'll look at a 5-minute chart, get the idea of the trade for the 5-minute chart. They'll place the trade on a 5-minute chart, and then they go over to a 1-minute chart and they snug their stop up as tight as they can because they don't want to lose any money. Well, that's just fear speaking. It's just fear. And what ends up happening inevitably is they end up stopping out, end up losing, and then they say, I can't figure it out. The trade does what I want it to do, but I keep losing, and I don't know why. And then there's two ways that goes. Either one, they stop using stops altogether, and that just leaves you vulnerable. Or, they just start to blame all sorts of things. It can spiral, say, well, it's the market makers doing this. Just all sorts of challenges happen whenever you keep putting your stop too tight. So the principle is this: we want to set it just below your support level. Now, if you got a horizontal support and resistance line like we've got here, that's usually a good idea. Or if you're in a trend, like this example here on Caterpillar, I will very, very often use my moving averages, and I'll set the stop just below the moving average. The moving average is an excellent place to set your stop in a trend, because what the moving averages do is they outline the trend. They outline the greater trend. And so when it starts moving below the moving averages, you know something's off. Now the question would be, do I set it below the 10 period, the 20 period, or the 50 period, or a different one? And the answer is yes. It's whichever one you need. Let's come over here to our live charts, and let's just look at some examples that we've set up. And I'm going to start. Now, we happen to be in some bearish markets, so a lot of our trades right now are bearish. But this is on Apple. And what I want to show you is how we did this for our Sunday night class. We've got our entry right here at, 187.50 or so, 187.59. This is a bearish trade, so we're expecting this trade to come down. But you notice where we put our stop is right above our resistance. Put our stop in here at 198.77. It also happens to coincide with our 10-period moving average. When you set your trades up, it's very important that you set the stop where the chart dictates. You need to look at your support and resistance, and you need to set it accordingly. If you try to set your stop based on what your own personal risk tolerance is, it's not going to work. You'll be getting stopped out all the time. If you try to set your stop based on what, maybe you say, well, my account can only sustain a 1% loss or a 2% loss. If you set a 1 or 2% stop, no. You have to set the stop based on where the chart suggests it goes. Let's look at a more neutral trade here. Let's look at one on Palantir. This is a trade that actually could be bullish right now. It's neutral. We're not in this trade yet. But hypothetically, if this trade were to continue, and probably tomorrow night or Sunday night in my profit picks, I'll probably be setting this one up. We're going to put an entry right here at about $100 a share. That'll be your entry. Now, our target is pretty obvious. Our target's going to be about 125. Go back to your last swing high. That's your next resistance line right there. And you say, okay, well, where should my stop go? So a couple of ways we can approach it. One is to look to the left and find our previous support level. And I don't want to mark this on the chart right now because this is a chart that we use a lot. But one spot to put it would be identify in this little price trading range here where our pivot would be. And that would be about 79.16. Where you see my cursor right there. I'll go ahead and put it in there. Never mind. See, that is a pivot area. You can see how much resistance we hit here. You can see the support that we hit here. You can see that we hit it as support here, trading all around it. That is your pivot. So that becomes a reasonable spot to set a stop. You could come all the way down here and set your stop down there. But that's going to open you up to way more risk than you need. Here's the reality on this trade. Not all trades are like this, but in this particular scenario, what would be more reasonable for you is to look at these moving averages and say, well, somewhere down here, if I start moving below my averages, I need to be done with this trade. That's the principle, by the way. When you need to figure out where you set your stop, the question is, where am I no longer interested in this trade? At which price point does it become no longer interesting to me? And in this case, it should be about where the price were to start, if the price were to start moving down below your moving averages. So if the price starts to come down, you get to below your 50-period moving average. In this case, you'd say, yep, I'm out. So that becomes a good stop, a good stopping ground. Now, in different trades, and I'll find another one here in a moment, the 50-period would not be the right place to set it. But in this case, it would be. So what you would do is you figure out what that price point is. And that price point happens to be about 87.40. And that's going to be your stop. Now you've defined everything that you need. Here's your risk. And in this case, that risk is going to be about, $12.60. And you have your reward, which in this case is going to be about $25. And if you look at that and you kind of do some quick math in your head, you say, you know what? That's right at a $2 reward for every $1 risk that I put into the trade. So can you place this trade? And the answer is yeah, that works within your risk-reward ratio, within your profile that you're looking to do. And if you do that type of discipline, that type of a trade, and if it gets down to 87.40, if you get out, now what you're doing is you're trading like a disciplined trader. Now you can start to run the statistics that we talked about the last 2 days. You say, okay, if I'm winning 50%, if I'm winning 60% of my trades, and if I'm making $2 for every trade that I lose on, I only need to win half of them. I'm in great shape. Boom. Now you can sustain your 5 losses, your 4, 5, 6 losses, whatever it's going to take. And it becomes an equation. It becomes very easy to work with, very easy to execute and to deal with. Okay, let me see if I can find another one in here that we can look at that's a little bit more of a bullish trend, because I want to show you another scenario. And this one on Dollar General is a perfect scenario. In fact, this is a trade we set up Sunday night. Actually, because it's already set up for you, I don't have to walk through it. But this is one that we set up this Sunday night in our Profit Picks class this past Sunday night. And we had an entry right here at $90.05. And you'll notice that my stop is sitting right down here below my 50-period moving average, about 82.48. Okay? And we got our target 1 and our target 2. Now, if you happen to use this little green and red tool in TradingView, you will also notice that it gives you, right here, I got to hover over it, it gives you a risk to reward ratio, which in this case is $3.89 for every dollar you're putting at risk. Pretty decent. And moreover, as the trade gets going, which it just started to do today or yesterday, you're going to want to start to tighten your stop, and eventually you'll be moving your stop higher. I don't have time to go into all those details today, but I do teach that in my stops course and teach you how we work through that. What I want you to see here today is how you set your stop below your support level to allow the trade room to move. So now, even though we've triggered this trade could come back down here and it might do something like that, still get to our target. You say, is that realistic? Absolutely. Just because it starts in a direction doesn't mean that it's going to go straight there. It doesn't mean that it's going to go from trigger point straight to our target every time. Sometimes that happens. But it's very common that we'll trigger a trade, it'll come right back down, get stuck in that kind of neutral zone again, and then it will continue. And that's why we have to create a cushion for your stop. And so this is the easiest way to do it. Either put it below your support level, or if you're in a trend, put it below your moving averages. I'm looking for another example where we have one where I didn't use the 50 period. And I'm not sure I got one. Oh, here we go. This is going to be one. Now, Exelon, this is, I say, when we set this up, I use the 50 period, but as this trade is going right now, Sunday night, we will adjust this stop, and we'll pull this stop up to our 20 period moving average. And if you were setting this trade up today, that's where you would want your stop to go. You don't need all this risk now. Now that we're 4 days into the trade, again, this is one we set up Sunday night, you're 4 days into this trade, you've already gotten almost to your first target. You don't need to have so much cushion in here. You don't need all that cushion. So now that you're in the trade, you pull your stop up to your 20 period, eventually your 10 period, and then you continue to tighten your stop as the trade goes. And by doing so, what you're doing is you're locking in profit. All right. So let me give you a couple of key takeaways, and then we'll wrap it up a little bit early today on this Good Friday. Takeaway number 1, when possible, it's good to automate your capital preservation. When possible, it's good to automate your capital preservation. Number 2, the reason we do that is that it removes emotions and it requires less monitoring. So we want to remove our emotions and we want to have less monitoring involved. And most importantly, the tools are out there. Why in the world would we not use them? The tools are there. Why would we not use them? Of course, the answer is I don't trust them. But you need to learn how to trust them, learn how to use them. And if you're getting stopped out early, if you're getting stopped out when you don't want to be stopped out, you just have to learn how to set your stops better. And again, that's why we have my course. All right. If you haven't liked and subscribed to the channel, haven't followed, then please do so. Those of you over on Rumble, follow. Those of you on Facebook, follow. Those of you here on YouTube, like and subscribe. And I hope you all have a fantastic weekend. I hope everything goes great for you. Hope you have a wonderful remainder for your Good Friday and a wonderful Easter weekend. Next week, we will be hitting it again. I'll do a couple of lessons next week. And then we will be transitioning after the first of the month into the new Wall Street Secrets Live. And I think you're really going to love it. So with no further ado, if you don't have any other questions, then we will conclude today. And again, thanks for being here. Hope you have a great weekend. Happy trading to all of you. We'll talk to you soon. Have a great day.